In every market downturn, the problems are part economic and part psychological. There's no denying our economic problems. Oil vacillates weekly. The declining U.S. housing market has resulted in write-downs of $400 billion worldwide, with more to come. What is a physician to do in these turbulent times? Where should we be placing our hard-earned dollars? Welcome to the Business of Medicine. I'm your host, Dr. Larry Kaskel. Joining me today is Bill Cleveland, a CPA and certified financial planner with Preston and Cleveland Wealth Management in Augusta, Georgia. Bill, welcome to the show.
Thank you, Dr. Kaskel.
Well, Bill, where should I be putting my money? Should I just shove it in the mattress?
Well, we've had a few clients ask us that lately, and one of the difficult things right now is obviously the emotions, and we see this in extreme up markets as well as the extreme down markets. And to us, the key is consistency over time. And, especially with doctors who are investing money on a monthly basis, and especially for those, that are not going to retire tomorrow, these times are actually great times to be investing in the stock market.
Let's talk about that. You say they're great times. I've always heard that when the sky is falling and there's blood in the streets, that is the time to buy.
Sure.
You want to take advantage of the panic, and the herd is usually wrong.
Right. We like to watch what we call the experts. I mean, you look at your Warren Buffett's, Berkshire Hathaway, your Bill Gross's, who's with PIMCO out in California, and your endowments, and you kind of watch what they're doing. They're the ones that were disciplined and had cash to take advantage of these opportunities, and they're buyers now.
Mm-hmm.
So, which is typically exactly the opposite of what I would call the average investor does, and there's been a lot of studies done on this. Dalbar, DALBAR.com, has some great studies on this. The average investor actually pulls back right now and then waits for the market to run up and then invest, so they get kind of hurt on both sides.
I heard on CNBC this morning, actually, they were trying to find the difference between an investor and a saver, and they were saying an investor actually takes advantage of leverage. Do you agree with that?
To a certain extent, if it's smart leverage, I would say. I'm pretty conservative by nature. I think a lot of our clients are fairly conservative. I mean, they want to use leverage, what I call smart leverage, to a certain extent. Maybe having some mortgage debt if they're trying to buy an office building for the practice. Obviously, the ideal world, I guess you could pay cash for anything, but I don't know too many people that can do that. So you have to use leverage to a certain extent to grow your business. But at the same time, we're moving into a market environment where very few people are going to be able to do 100% loans anymore.
Which is good. That's how we got into trouble.
Yeah, and credit standards are tightening. If you buy a lot now, you're going to have to put more money down. So you can still use smart leverage, but you're not going to be able to, and you don't want to overextend yourself, which I think can hurt you financially. So there's a happy medium, I think, somewhere in between there.
What can we learn from the Consumer Sentiment Index, where it's at currently in relation to history? Do you use that as a good barometer?
We look at it as one tool. We don't put a whole lot of weight into any one stat. We tell clients right now the market by any measure is undervalued. If you look at price-earnings ratios, what have you, any objective measures, but it can always get cheaper. You never can pick the bottom. Same thing with consumer sentiment. I mean, most people think of consumer confidence, which is really how are we feeling today? How does the average person feel about things today? And it's not so good. Some of the recent measures that have come out on that are pointing to consumer confidence being at all-time lows. Most people look at that and say, wow, things are tough. I really shouldn't be investing now. I shouldn't be buying a house. I shouldn't be investing. But typically that's what most people call, and historically has been, a lagging indicator versus a leading indicator. Typically, when consumer sentiment has hit lows before, that has been where the markets tend to bottom out, and there's been some nice returns historically when consumer sentiment has hit its lows. I hedge that a little bit by saying, who knows if June is the lows of consumer sentiment. So that just gets back to our first point that, we strongly believe that the key to being successful over time is being a disciplined investor, having a smart asset allocation. people learned a long time ago that used to think 15 tech companies was a diversified portfolio, but you have to have a well-diversified portfolio. We believe these times are as good as any to be an investor, but we definitely don't know if it's the bottom or not.
If you've just tuned in, you're listening to The Business of Medicine on ReachMD XM 157. I'm your host, Dr. Larry Kaskel. Joining me today is Bill Cleveland from Preston Cleveland Wealth Management from Augusta, Georgia, and we're talking about where to put our money these days. Bill, you wrote a column in Medical Economics on dividend-paying stocks. Can you kind of define what a dividend is and what's considered a good dividend?
Sure. If you look at your basically corporation, simplify it to a certain degree, but they typically, are earning cash flow. They have earnings. They have the option of reinvesting those earnings in a business, which a lot of your higher growth companies do. So they'll pay no dividends or a very small dividend. Or companies will say, okay, well, I want to reinvest some of it, but I want to return some of that money to shareholders. So they'll actually pay that money out in cash, typically quarterly. And most of the time, if you have a brokerage account, it will just show up in cash in that brokerage account. And they'll pay that dividend out quarterly.
Will that dividend automatically get reinvested, or do you have to kind of designate if you want it?
Well, there are automatic reinvestment plans out there. I think it can go either way. If you want to have it reinvested, I think you can work with your advisor to do that. Probably a typical brokerage account, most of the time, it probably gets paid into cash.
And if a physician's near retirement, I would imagine his needs are changing, and he probably could use that cash as income.
Anytime we look at portfolios, we are always adamant about having broad-based diversification, and we typically use 7 to 10 different asset classes. And when we say asset class, we mean U.S. stocks, large cap would be an asset class, bonds, cash, those would all be different asset classes. But we look at dividend-paying stocks as one of those asset classes that is going to generate some income over time that will work with the other asset classes we have in the portfolio to kind of meet our goals, meet the kind of income that we need to live off on.
All right, let's do a real-life example. I am a 46-year-old physician. I do not plan on retiring for at least another 10 to 15 years. Do I need any dividend-paying stocks in my portfolio currently?
I don't see why not. We'd obviously want to drill a lot deeper and get to know the details of that individual, but going forward, dividends obviously weren't very popular in the late 90s. Everyone thought it was a new paradigm, and we were going to earn 15 to 20% returns indefinitely. Dividend-paying stocks were not popular at all then. Who would want a 3% dividend when you can make 20%? But going forward, and we always be a little hesitant when we say the experts think, but most smart people I read think returns are going to average between 6 and 10%, depending on who you read going forward. So dividends are going to be a much more important component of your equity return going forward, and I don't see why not. A 46-year-old would not want to have some of his or her portfolio in a dividend-paying company.
How would you feel about buying a dividend-indexed fund instead of specific stocks?
It's always a difficult time to be an individual stock picker, but this is a even more difficult time because there's so much unknown risk in one stock. There's so much behind the scenes. You can evaluate balance sheets and income statements all day, but there's so much risk out there that is just unknown. You name your favorite bank right now, Bear Stearns, Enron, WorldCom. All of these companies were darling stocks at one time. Anytime you're trying to pick the best dividend stock, you're always going to run into that unknown risk.
So if a physician is looking for dividend-paying stocks and he finds one that is paying a nice yield, let's say 9-10%, is that a sign of bad things to come?
Well, it could be. It very well could be. Because a 9 or 10% dividend is definitely way above average. I think 2 to 3% is probably average. Some companies are now, because their stock prices come down, are paying much higher than that. But you're right. The company's dividend yield is basically calculated as the expected annual dividend over the next 4 quarters divided by the closing price. So If Company A had a dividend of $1 and its stock price was at 100, it'd have a yield of 1%. Company B had a dividend of $5 and a stock price of 100, its yield would be 5%. But let's say Company B's stock price goes to 50, it would then be paying a 10% dividend, which sounds wonderful, but there's a lot more behind the scenes that you need to look into.
What happened with Citigroup this year?
Citigroup, don't want to, just single them out, but all of the banks have obviously had a tough time. And, Citigroup was paying a dividend of close to 8%, on January 14th. But the reason its dividend was so high was because the stock was down 50%. Shortly thereafter, the dividend was cut, 41%, and them and other banks have had to cut, dividends throughout this year in order to try to conserve cash. So you want to be very leery of high dividend-paying stocks and really try to look under the hood and understand why those dividends being paid are so high. There's no free lunch. So I think people need to understand that while dividend-paying stocks can be good for a portfolio, the principal is not guaranteed. So you want to make sure you understand what you're buying.
And I guess there's some uncertainty out there also about dividend taxes?
Well, there is. Right now, capital gains, basically if I buy a stock at 5 and it goes to 10 and I hold it for over a year, then capital gains, long-term capital gains taxes are 15%, and dividends taxes are at 15% as well. There's certain restrictions within that, but in general, that's the case. We only have basically 2 more years of that, 2009 and 2010, and then that expires. So if nothing is done, we'll go back to dividends being taxed at ordinary income tax rates, which federally right now are as high as 35%. So that obviously would be a significant disincentive, if you will, for companies to pay out higher dividends. And depending on your individual tax bracket, obviously you'd have to relook at things, if that was the case. Depending on who's elected president this year, that could change next year. As everyone knows, Congress likes to tinker with the tax laws fairly often, so that's not a guarantee that we even have 2 more years of that.
Bill Cleveland of Preston Cleveland Wealth Management from Augusta, Georgia. Thank you very much for talking with me today and teaching me a little bit about how to be a better investor.
Yeah, well, thank you, Dr. Kaskel.
I'm Dr. Larry Kaskel, and you've been listening to The Business of Medicine on ReachMD XM 157. To comment or listen to our full library of on-demand podcasts, please visit our website at reachmd.com. You can now reach us by phone with comments or suggestions at 888-MD-XM 157. And thanks for listening.